They wanted silence. They wanted a quiet holiday. They wanted Christmas Eve to pass without incident. But the silver market refused to cooperate, because while the Western screen is showing $72, something far more dangerous is happening off-screen. Right now, not yesterday, not last week, physical silver in Shanghai is trading at $78.49, and today, the market moved with violence. Silver screamed 8.12% higher in a single session. Let that number sink in. That's not a rumor. That's not a projection. That's a real physical price being paid for metal that must be delivered. This means the arbitrage gap, the difference between paper silver in the West and physical silver in the East, has exploded. The China silver premium has widened to an unimaginable $7 per ounce in some contracts. And in the most liquid contracts, we're seeing premiums over $8 per ounce. Tonight, I'm going to explain why this gap is not stabilizing, why it's accelerating, and why a $10 plus gap by tomorrow, Thursday, is no longer an extreme scenario. This is not a rally, this is not volatility, this is system stress. And once a gap like this starts to expand, markets don't close it politely, they close it violently. In this emergency breakdown, I'm going to show you why the 78.49 Shanghai print and the 8.12% single-day surge changes everything. I'm going to reveal what 17.7 metric tons of silver being removed from SHFE vaults in one day tells us about physical demand. I'm going to explain why the arbitrage mechanism is broken and what it means when metal stops flowing from west to east. I'll detail the mechanics of gap expansion and why $7 to $8 premiums don't stabilize, they snap. I'm going to walk through the gamma trigger zone and why the $75 to $80 range is where forced buying turns exponential. And I'm going to give you the 5 signals to watch in the next 24 hours that will tell you whether this gap explodes or contracts. The Western price is becoming irrelevant. Shanghai is setting the real price. And when the gap hits $10, it won't be a trading opportunity. It will be a system break. This is the story of the moment price control failed. And it's happening right now. Let's establish the most important rule in commodities. In surplus markets, paper sets the price. In deficit markets, physical does. We are no longer in a surplus market. And today proved it with mathematical precision. An 8.12% move in a single session. That's not speculation driving price. That's desperation. Shanghai is not trading futures fantasies. Shanghai is trading metal that must be delivered, bars, kilograms, industrial lots. And today, someone was willing to pay $78.49 for that metal. But here's what makes this truly extraordinary. The premium structure. The China silver premium didn't just widen, it exploded. We're seeing $7 per ounce premiums in some contracts, over $8 per ounce in others. Let me put that in perspective. Normal premiums in functioning markets are 1 to 3%. That's 70 cents to $2 per ounce at current prices. Today we saw premiums of $7 to $8. That's 10 to 11% over Western spot. This is not normal market behavior. This is panic behavior. When Shanghai prints 78.49, it's not making a suggestion. It's placing a bid of survival. Factories do not care about RSI. They do not care about moving averages. They care about whether the line stops tomorrow morning. So the moment Shanghai accepts 78.49 and the moment premiums explode to $7 and $8 per ounce, the global silver market changes phase. At that point, the Western price is no longer a reference. It's a discount. And discounts in commodity markets don't last when the underlying asset is scarce. Because when something is genuinely scarce, the discount gets arbitraged away, unless the arbitrage mechanism itself is broken. And that's exactly what we're seeing. The bridge between West and East is collapsing, not metaphorically, mechanically. And we have proof, physical proof. 17.7 metric tons of silver were removed from Shanghai Futures Exchange vaults today. In one day, let me convert that for you. 17.7 metric tons equals approximately 569,000 ounces. Gone, removed, taken into private storage or industrial consumption in a single session. This is not normal drawdown. This is systematic depletion happening at an accelerating rate. And it's happening at the exact moment premiums are exploding. Why? Because buyers aren't trusting the exchange system anymore. They're taking physical delivery, they're moving it to private vaults, they're securing supply before the vaults go empty. This is the behavior you see right before a market breaks, not gradual drainage, panic drainage. Now let me explain how arbitrage is supposed to work, because understanding the normal process is critical to understanding why it's failing. In a normal world, a $6.49 arbitrage gap would close instantly. Here's how. Step 1, buy cheap in New York at $72. Step 2, ship to Shanghai. Step 3, sell high at $78.49. Step 4, pocket the difference. After shipping and insurance costs, that's probably $4 to $5. Net profit per ounce. Risk-free, this is textbook arbitrage. And in a functioning market, thousands of traders would execute this simultaneously. Their buying in New York would push the New York price up. Their selling in Shanghai would push the Shanghai price down. The gap would close within hours. That's how markets self-correct. That's how global prices stay aligned. But here's the problem. There is not enough physical silver available in the West to close the gap. The arbitrage mechanism is broken. The metal isn't flowing fast enough. And in many cases, it isn't flowing at all, which creates a vicious loop. Shanghai pays more. Metal tries to move east. Western vaults drain. Western supply tightens. Shanghai raises the bid again. That's how $6.49 gaps don't shrink. They stretch. And today we saw the acceleration. An 8.12% move in one session. Premiums exploding to $7 and $8 per ounce. Physical withdrawal of 17.7 metric tons. These are not signs of a market in equilibrium. These are signs of a market in distress. And historically, when a commodity gap exceeds 8 to 10%, markets don't glide. They snap. Let me give you the math. Current Western price, $72. Current Shanghai price, $78.49. Gap, $6.49. Percentage gap, 9%. We're already at the danger threshold, but that's just the spot gap. When you look at premiums on actual physical delivery, we're seeing $7 to $8 above Western prices. That's $79 to $80 for guaranteed delivery. That's an 11% spread at the high end. And we're approaching this during the worst possible timing. Christmas Eve, thin liquidity, lightly staffed risk desks, reduced trading volumes. This is when markets are most vulnerable to dislocations, because when something breaks during thin trading, there aren't enough participants to absorb the shock. Prices don't adjust smoothly. They jump, they gap, they reset in single violent moves. And if Shanghai opens firm or higher tomorrow at 78.49 or above, Western traders wake up behind the curve. They wake up to discover that the real market moved without them. And here's the psychological pivot that matters. Once industrial buyers accept prices near $80, the question changes. It changes from what's the price to can you deliver? That's when bids stop negotiating and start leapfrogging. This is how prices jump in steps, not candles. $78 to $79 to $80. Not over weeks, over hours. In part 2, we're going to dive into why the Western vaults can't supply enough metal to close this gap. Because understanding the supply constraint is critical to understanding why the gap is accelerating instead of contracting. Stay with me. We're going into the mechanics of the drain. If you're just joining us, we've established that Shanghai is trading physical silver at $78.49 while Western paper shows $72. That's a $6.49 arbitrage gap. The China premium exploded to $7 to $8 per ounce today. Silver surged 8.12% in a single session, and 17.7 metric tons were physically withdrawn from SHFE vaults. These are not normal market conditions. In part 1, we showed the gap and the broken mechanism. In part 2, we need to understand why Western supply can't flow fast enough, because this is the core of the problem. The metal isn't there, not in the quantities needed, not in the time frames required. Let me walk you through what's happening in Western vaults right now. COMEX registered inventory, the silver available for immediate delivery, has been draining for months. 3 months ago, over 120 million ounces. 2 months ago, 95 million ounces. Last month, 73 million ounces. This week, likely below 70 million ounces. That's a 40% decline in available inventory in 90 days. This is not normal drawdown. This is systematic depletion, and it's accelerating. Why? Because the arbitrage we just described isn't theoretical. It's actually happening. Traders are buying Western silver and shipping it east. But the rate of drain exceeds the rate of replenishment. And today we saw proof of the eastern drain. 17.7 metric tons removed from Shanghai vaults in one day. That's 569,000 ounces in a single session. Annualize that rate, and you're looking at over 200 million ounces per year being pulled from just the Shanghai system. That's more than the entire annual production of Mexico, the world's largest silver producer. Here's why. Mining production is relatively fixed. You can't just dig faster. Refining takes time. You can't speed up the chemical processes. Logistics take weeks. You can't teleport metal across the Pacific. So even when the arbitrage opportunity exists, even when traders want to exploit it, the physical constraints limit how fast metal can move. And while metal slowly makes its way east, demand in Shanghai doesn't wait. It accelerates. More factories need silver, more production lines start up, more contracts need to be filled. The demand is constant and growing. But the supply is episodic and shrinking. This creates a gap, and the gap creates pressure, and pressure creates higher prices. Today's 8.12% surge is the market discovering this pressure in real time. That's not a normal move. That's a repricing event. That's the market saying the old price was wrong. The new price is $78.49, and maybe higher tomorrow. Now, here's what makes this particularly dangerous. The West is not just supplying Shanghai. The West has its own industrial demand. American solar companies need silver. European electronics manufacturers need silver. Western defense contractors need silver. So the available float, the metal that can actually be redirected to arbitrage, is smaller than the total inventory suggests. Think of it this way. Total Western inventory might show 500 million ounces, but 300 million is already allocated to ETFs. Another 100 million is committed to industrial contracts. That leaves 100 million as the tradable float. And from that 100 million, you have to subtract what's needed for domestic industrial use. What's left? Maybe 30 to 50 million ounces that can actually move to close the arbitrage gap. But Shanghai needs 200 million ounces annually just for solar panels, plus electronics, plus batteries, plus everything else. The math doesn't work. The supply available to close the gap is a fraction of the demand creating it. So the gap doesn't close, it widens. And as it widens, the pressure intensifies. And when pressure intensifies, you get days like today. 8.12% moves, $7 to $8 premiums, 17.7 metric tons withdrawn. These are the symptoms of a market in crisis. Because now it's not just arbitrage traders trying to move metal. It's industrial buyers in the West competing with industrial buyers in the East for the same shrinking pool of available silver. And when industrial buyers compete, price doesn't trend. Price explodes. This is the drain mechanism. Every day the gap persists, more metal flows east. Every ounce that flows east is an ounce that can't be delivered in New York. Every ounce that can't be delivered in New York makes the Western market tighter. Tighter. Western markets make the Shanghai premium more attractive. More attractive premiums pull more metal east. The loop reinforces itself. This is why I'm saying a $10 gap tomorrow is plausible. Because if Shanghai opens at $78.49 and Western supply can't respond, and industrial buyers in Shanghai get more urgent, the bid goes to $80. Then $82. And suddenly the gap isn't $6.49. It's $10 or $12. And at that point, the Western paper market faces a credibility crisis. Because how can you claim to be setting the global price when the physical market is trading $10 higher? And when premiums are exploding to $8 per ounce? And when physical metal is being withdrawn at a rate of 17.7 metric tons per day? You can't. The fiction collapses. In part 3, we're going to explain the timing, why tomorrow specifically is so dangerous, and why thin holiday liquidity turns small gaps into massive dislocations. Stay with me. We're going into the catalyst. We've reached part 3. We've shown you the $78.49 Shanghai price and the explosive 8.12% move. We've explained why Western supply can't close the gap. Now, we need to talk about timing. Why tomorrow, Thursday, is the most dangerous day. Because markets don't break randomly. They break when conditions align. And tomorrow, every condition is aligned. Let me explain why holiday trading is so dangerous. Normal trading days have depth, lots of participants, market makers providing liquidity, hedge funds balancing flows, retail providing absorption. But holidays are different. Liquidity is thin, many traders are off, risk desks are lightly staffed, trading volumes drop, and when liquidity drops, volatility increases. Because it takes less force to move the price when there are fewer participants. Think of it like this. In a crowded room, you can push someone and the crowd absorbs it. But in an empty room, a small push sends them flying into the wall. That's what thin liquidity does to markets. Small orders have an outsized impact, and today proved it. An 8.12% move in silver. In normal conditions with full liquidity, that kind of buying pressure might move the market 2 or 3%. But in thin pre-holiday trading, it moved 8.12%. That's what happens when there aren't enough sellers to absorb the bids. The price just jumps. Now add the timing of Asia opening before the West. Shanghai opens at 9 p.m. Eastern Time on Wednesday. New York doesn't open until 8 a.m. Eastern on Thursday. That's an 11-hour gap. During those 11 hours, Shanghai can trade. Western traders are asleep. They can't respond. They can't intervene. They can't manage risk. So if Shanghai opens firm at $78.49 or higher, that price stands for 11 hours before the West can even react. And here's what happens during those 11 hours. Asian industrial buyers see the price. They see it held through today's session despite the massive 8.12% surge. They realize the momentum is real. They get more confident. Some who were waiting decide to buy. Their buying pushes the price higher, maybe to $79, then $79.50. By the time New York wakes up, Shanghai might be at $80. And New York is still showing $72 from yesterday's close. The gap is now $8, not $6.49, $8. That's an 11% spread. And when New York opens and sees that gap, what do? Do they smash the price down to close it? They can try. But if physical demand is real and today's 17.7 metric ton withdrawal proves it is, paper selling won't work. The gap will persist. or widen. And that's when panic starts. Because if Western paper can't close an 11% gap, the market realizes that paper has lost control. And when paper loses control, physical takes over completely. This is the nightmare scenario for comics, not that prices rise, but that they rise in a way that exposes the paper market as irrelevant. Now let's add the gamma mechanics on top of this timing. The $75 to $80 zone is loaded with call options. When market makers sold those calls, they assumed they had time to hedge. They assumed normal market conditions. But tomorrow isn't normal. It's Christmas Eve, thin liquidity, explosive gap, 8.12% daily moves. If Shanghai pushes toward $80, market makers have to hedge. But hedging in thin liquidity is brutal because there aren't enough sellers, so they have to lift offers aggressively. They might have to buy at 73, then 74, then 75, just to fill their hedge. And their buying pushes the price higher, which requires more hedging, which pushes the price higher again. This is forced buying in thin liquidity, and it's how you get $5 moves in a session. So tomorrow has everything. Asian Open setting the tone overnight, Western traders waking up behind, thin holiday liquidity amplifying moves, gamma hedging forced to chase, industrial buyers competing for scarce metal, physical withdrawals at rates of 17.7 metric tons per day, premiums at $7 to $8 per ounce. That's not a trading environment. That's a dislocation waiting to happen. And if the gap hits $10, it's not just a number, it's a psychological break. Because $10 gaps in major commodities are rare. They signal that something fundamental has broken, that the normal mechanisms of price discovery have failed. And when those mechanisms fail, the reset is violent. In part 4, we're going to walk through what industrial demand looks like at these levels, because understanding why buyers don't stop at $78 or $80 is critical to understanding why this gap can expand beyond what seems rational. Stay with me, we're going into the psychology of inelastic demand. We've reached part 4. We've shown the gap, the broken arbitrage, and the dangerous timing. Now we need to understand the buyer psychology that drives this gap wider. Because at $78.49, you might think buyers would pause. They don't. Today's 8.12% surge happened because buyers kept buying. Let me explain. Industrial demand. It's fundamentally different from speculative demand. Speculators are price sensitive. If silver gets expensive, they walk away. They wait for a better entry. They have time. But industrial buyers don't have time. And they're not price sensitive in the way you think. Here's why. Imagine you run a solar panel factory. You have contracts to deliver 10,000 panels next month. Those contracts are worth $5 million in revenue. Each panel needs 20 grams of silver. That's 200 kilograms total, or about 6,430 ounces. At $72 per ounce, that's $463,000 in silver costs. At $78.49 per ounce, that's $505,000. The difference is $42,000. Sounds like a lot, right? But here's the thing. If you don't get the silver, you can't deliver the panels. If you can't deliver the panels, you lose the $5 million contract. You might also face penalty clauses. And you damage your reputation for future contracts. So what do? Do you hold out for $72 silver and risk losing everything? Or do you pay $78.49 and preserve the $5 million? You pay. Every single time. Because $42,000 in extra cost is infinitely better than $5 million in lost revenue. This is why industrial demand is inelastic. The cost of the input is small relative to the value of the output. And the cost of not having the input is catastrophic. So industrial buyers don't negotiate on price. They negotiate on delivery. Can you deliver next week? Can you guarantee the quantity? If yes, I'll pay. If no, I'll pay more to someone who can. This is the psychology that drives gaps wider. And this is why we saw 17.7 metric tons withdrawn today. Those weren't speculators taking delivery. Those were industrial buyers securing physical supply because they cannot risk the exchange system failing them. Because when multiple factories are competing for limited silver, they don't wait for prices to come down. They bid against each other. Factory A offers $78, Factory B offers $79, Factory C offers $80. Not because they want to, because they have to. A factory that hesitates is a factory that doesn't get the metal. It doesn't fill its contracts, and it goes out of business. Now multiply this across the entire industrial complex. Solar manufacturers, electronics producers, battery makers, medical device companies, defense contractors. All of them need silver. All of them have contracts to fulfill. All of them are willing to pay up to avoid production stoppages. This is why Shanghai hit $78.49 while New York shows $72. This is why premiums exploded to $7 and $8 per ounce. This is why 17.7 metric tons were withdrawn in a single day. Shanghai is where the industrial buyers are. Shanghai is where the urgency is. Shanghai is where the real price discovery happens. because Shanghai is where people who need silver compete for scarce supply. And when scarcity meets urgency, price becomes secondary. Now here's what makes this even more dangerous. As the price rises, urgency increases, because buyers who were hoping for a pullback realize the pullback isn't coming. Today's 8.12% surge told them the market is accelerating, not correcting. They realize they're behind the curve. They realize that waiting costs more than buying, so they stop waiting. They all try to buy at once, and when everyone tries to buy at once in a market with limited supply, price doesn't rise gradually. It jumps $78 to $80 to $82 in a day, because the question shifts from what's the right price to where can I get it? And once that shift happens, the gap doesn't contract. It explodes, because now you have Western speculators watching a $72 paper price, while Eastern industrial buyers are paying $78.49 for physical, with premiums of $7 to $8, which means the real price for guaranteed delivery is $79 to $80, and the $10 gap becomes reality. This is the mechanics of inelastic demand in a scarce market. It doesn't follow normal supply and demand curves. It follows survival logic. And survival logic doesn't care about technical levels or moving averages. It cares about one thing: securing supply at any cost. In the final part, I'm going to give you the 5 signals to watch in the next 24 hours and the roadmap for what happens if this gap continues to expand. Because understanding the theory is one thing, knowing what to watch in real time is what actually matters. Stay with me. We're finishing with the battle plan. We've reached the conclusion. We've shown you the $78.49 Shanghai price. We've detailed the explosive 8.12% move. We've revealed the 17.7 metric ton physical withdrawal. We've explained the broken arbitrage and the $7 to $8 premium explosion. Now we need to give you the practical framework, what to watch, what it means, and what happens next. Let me give you the 5 signals that will tell you whether this gap explodes or contracts. Signal 1, Shanghai price at open. Does it hold or rise above 78.49? If Shanghai opens Thursday morning at 78.50 or higher, the gap is confirmed. The overnight session didn't correct it. That tells you physical demand is real and persistent. After an 8.12% surge, any consolidation above 78 is bullish. If Shanghai opens at 77 or below, the gap is contracting. That's a different story. But if it holds or rises, the thesis is live. Signal 2, Western spot lag. Does the Western price close the gap or fall further behind? When New York opens Thursday morning, watch the first hour. If COMEX opens at 72 and Shanghai is at 79, the gap widened overnight to $7. That's acceleration. If COMEX gaps up to 75 trying to catch Shanghai, that's acknowledgement. But if COMEX stays flat while Shanghai rises, that's system breakdown. Signal 3, physical premiums. Do they remain elevated or expand? Check dealer websites, check wholesale quotes. Today we saw premiums explode to $7 and $8 per ounce. If those premiums hold or rise tomorrow, the physical market is pulling completely away from paper. If spot is 72, but dealers are selling coins at 88, that's a $16 premium. 22%. That confirms physical is decoupling from paper. If premiums are shrinking, the pressure is easing. But if premiums are rising, the physical market is declaring independence. Signal 4, dealer availability. Are you seeing delays, phone quotes, out of stock notices? If dealers flip from in stock to pre-order only, that's rationing. If they remove prices from websites and go to call for quote, that's scarcity behavior. Today's 17.7 metric ton withdrawal suggests physical is disappearing fast. Watch for dealers to acknowledge this through inventory restrictions. Signal 5, volatility without volume. Does price move on thin trading? Today's 8.12% move happened on what will likely be revealed as relatively thin volume. That's dangerous. If you see $2 moves on low volume tomorrow, that's a liquidity vacuum. And that's what happens when there are more buyers than sellers and the order book is thin. This is dangerous because it means small orders can trigger large moves, and large moves can trigger stops, and stops can trigger cascades. If these 5 signals align, the market is telling you one word: scarcity. And scarcity doesn't produce gentle trends. It produces resets. Now, let me give you the roadmap for what happens if the gap continues to expand. Scenario 1, the gap reaches $10 by Friday. Shanghai at 82, New York at 72. At this point, the Western paper market faces a credibility crisis. How can you claim to set the global price when physical is trading $10 higher, when premiums are $8 per ounce? When 17.7 metric tons are being withdrawn daily, confidence in COMEX pricing begins to crack. Industrial buyers start questioning whether paper prices are real. Some might start demanding physical delivery, which puts pressure on registered inventory, which accelerates the drain. Scenario 2, the gap triggers intervention. COMEX raises margins. Regulators issue statements. Trading halts are threatened. This is the system fighting back. But rule changes can't create silver bars. They can slow paper trading, but they can't fix physical scarcity. So intervention might slow the move, but it won't stop it. Today's 8.12% move happened despite whatever controls are already in place. More controls won't change the fundamental equation. Scenario 3, the gap forces a repricing event. At some point, Western paper can't maintain the fiction anymore. The gap is too wide. The credibility is gone. The physical withdrawals are too large. The market forces a reset. COMEX gaps up $8 in a single session to catch Shanghai. This is the violent close we've been warning about. Not gradual, sudden. One massive repricing that leaves traders scrambling. And after today's 8.12% move, the market has proven it can move violently. Tomorrow it might move even more. Now, which scenario plays out depends on how fast the gap expands and how long Western markets try to resist. But all three scenarios lead to the same place, higher prices. Because the fundamental reality hasn't changed. Physical supply is limited. Industrial demand is growing. 17.7 metric tons were withdrawn in one day. Premiums exploded to $7 and $8 per ounce. And Shanghai is willing to pay $78.49 or whatever it takes to secure metal. So here's the bottom line. You can keep watching the Western screen and celebrating that silver is only at $72. Or you can understand what Shanghai at $78.49 actually means. What an 8.12% surge means. What $7 to $8 premiums mean. What 17.7 metric tons of physical withdrawal means. It means the real price has moved on. It means the physical market is no longer following paper. It means control is shifting from west to east. And it means that when the gap hits $10, this won't be remembered as a rally. It will be remembered as the moment price control failed. If you're holding physical silver, you're positioned correctly. Your metal can't be arbitraged away. Your bars can't be settled in cash. You have the asset. Today, 17.7 metric tons were removed from Shanghai vaults by people who understand this. But if you're waiting for a dip to buy physical, understand that the dip might not come. Today showed 8.12% moves in the opposite direction. Or it might only exist on paper, while physical premiums stay firm at $7 to $8 over spot. The window is closing, not in months, in days. Because once this gap breaks into double digits, once Shanghai firmly establishes 80 plus as the floor, the reset will be violent. And by the time it's obvious to everyone, the move will be done. So here's what you do tonight. Watch Shanghai open. If it holds 78.49 or goes higher, the thesis is confirmed. Watch the spread. If it widens, instead of narrows, the drain is accelerating. Watch for the signals, premiums, availability, volatility, physical withdrawals, and prepare for the gap to expand. Because $10 spreads in major commodities don't happen by accident. They happen when systems break, when mechanisms fail, when physical overwhelms paper, and we're watching it happen in real time. Today was the warning. An 8.12% surge, premiums exploding to $7 and $8. Physical metal disappearing at 17.7 metric tons per day. Tomorrow might be the confirmation. Subscribe, because the next 72 hours won't be analysis, they'll be scorekeeping. We'll track every tick in Shanghai, every gap reading, every signal, every physical withdrawal. And when the $10 gap prints, we'll know exactly what it means. Not speculation, confirmation. Confirmation that the arbitrage bridge collapsed, that Western vaults couldn't supply enough metal, that physical demand in the East overwhelmed paper supply in the West, and that the price you see on your screen was never real. It was just the last number the banks could defend before physics took over. This is not fear. This is not hype. This is observation of a market under extreme stress. Shanghai is at 78.49 after an 8.12% surge. New York is at 72. The gap is 6.49 and widening. Premiums are $7 to $8 per ounce. 17.7 metric tons withdrawn in one day. All right, let's break down what's happening in the markets right now because, frankly, it's a setup for some serious fireworks. All right, we're seeing a perfect storm brewing, and it's something every single one of you needs to be aware of. We have thin holiday liquidity, which means fewer people are trading, making the market more susceptible to big swings. On top of that, we're staring right at a critical gamma trigger zone. For those who don't know, this is a technical level where options dealers are forced to buy or sell massive amounts of the underlying asset to hedge their positions, which can pour gasoline on any price move. And if that wasn't enough, we're witnessing outright panic buying in the industrial sector. These aren't speculators. These are real businesses that need physical silver to make their products, and they're scrambling to get their hands on it at any price. So when you combine thin trading volume, a technical powder keg, and real-world industrial panic, you have every single ingredient necessary for a violent, explosive repricing. The question is no longer if this is going to happen. The real question is when. And based on the signals we're seeing right now, especially after today's absolutely explosive move, The answer could be as soon as tomorrow. This is a critical moment, and I need you to listen carefully. Don't get caught watching the wrong market. The prices you see on your screen, the paper prices, are becoming a fantasy. Don't anchor yourself to outdated price levels from last week or even yesterday. What's coming is a complete reset. Let me spell it out for you. Imagine a $10 arbitrage gap opening up in a major global commodity market. This isn't some tiny illiquid asset. We're talking about silver. This is happening right after an unbelievable 8.12% surge in a single day, and premiums are hitting $8. This isn't normal market behavior. This is a system breaking. The paper market, the one most people follow, completely lost control of the narrative today. The real price, the true price of physical silver, is now being set in Shanghai. While the West is distracted, Shanghai is dictating what an ounce of silver is actually worth. And the physical metal itself? It's disappearing from vaults at a rate we have never seen before. We're not talking about small withdrawals. We're talking about 17.7 metric tons vanishing in a single day. This isn't just a number on a spreadsheet. It's a massive amount of physical supply being pulled off the market. And the rest of the world is about to get a very painful lesson in what true physical scarcity actually costs. Let's look at the evidence. The China silver premium has absolutely exploded. It's over $8 per ounce. That means buyers in China are willing to pay $8 more than the quoted world price just to get their hands on physical metal. This is a massive red flag. It tells you the paper price is a lie. When you see a single day price surge of over 8%, coupled with that kind of premium, it screams desperation. These aren't just statistics. They are the symptoms of a market in deep, deep crisis. And my concern is that tomorrow this crisis could accelerate dramatically. The pressure that's been building under the surface has finally erupted, and the forces that have been unleashed are powerful. We're talking about a potential gap up in price that leaves the old price levels in the dust. A move that doesn't look back. This is the moment where the disconnect between the paper price and the physical price becomes so vast that the entire structure has to reprice violently to catch up. So what should you do? First and foremost, watch closely. Pay attention to the Shanghai price, pay attention to the premiums, and watch the inventory levels in the vaults. These are the indicators that matter now. Second, position yourself accordingly. Understand the risks and the opportunities that a situation like this presents. Don't underestimate what happens when a market breaks. And finally, prepare for the gap. Prepare for that moment when the market opens at a price that seems impossible today. This could be the gap that changes everything. The disconnect between paper fiction and physical reality cannot last forever. Today, it started to unravel. Tomorrow, it might just snap. If you found this analysis helpful and want to stay ahead of these critical market shifts, please make sure you like this video and subscribe to the channel. Your support helps us get this crucial information out to more people. Thanks for watching, and I'll see you in the next video.